Everyone, and welcome to the Q1 FY21 results of the company. I hope everyone is keeping safe. Connecting with me today from our management is Mr. Diwakar Nigam, Chairman and Managing Director, Mr. Varadarajan, Whole-Time Director, Mr. Virendrajit, Senior VP Sales and Marketing and Product, and Mr. Arun Kumar Gupta, the Chief Financial Officer. Before we move on to the discussion, let me highlight that this call may contain certain forward-looking statements concerning Newgen's future business prospects and profitability, which are subject to a number of risks and uncertainties, and the actual results could materially vary from the forward-looking statements. Past performance may not be indicative of future performance. The company does not undertake to make any announcement in case any of these forward-looking statements become materially incorrect, or update any forward-looking statement made from time to time by or on behalf of the company. For further details, you may please refer to the investor relations section of our website. I would now hand over to Mr. Nigam for presentation of the results.
Good evening, everyone, and thank you for joining us at our Q1 FY21 post-result conference call. In the past 28 years, as an organization, we have witnessed several difficult economic cycles, which have made us more agile and resilient. As we end another quarter post-COVID, we see ourselves better empowered as an organization to combat the ongoing situation and emerge stronger in the long term. During this quarter, we have achieved revenues of rupees 132 crore. We continue to get business from our existing long-term customers. They have enjoyed the benefits of digitization during this period and are keen to go for more and more digital processes. We have ensured full support to our customers, helping them in maintaining their mission-critical business operations smoothly. We have also commissioned many new solutions for them completely remotely. On the new front, we made 22 new customer additions during the quarter. Some of these are in EMEA region. We have undertaken a mid-sized project for a global leader in energy transportation business based in Qatar. In APAC region, we are executing a project for one of the largest and fastest growing insurance companies in Philippines. In the US region, we have added 15 new logos in banking and credit unions, offering PPP, this is Paycheck Protection Program, and forgiveness solutions. These solutions were installed and made operational in just few weeks. These have made life of our customers really easy, as they could use the workflows from office as well as home and achieved their urgent work very easily. Moreover, these opportunities are expected to help us in deeper penetration in the region. Currently, Newgen is in dialogue with many of these clients for our regular lending and account opening solutions as well. The US region witnessed a revenue growth of 36% YOY during the quarter. As you are aware, COVID is bringing in a new kind of uncertainty to business environment. In this environment, SaaS-based workflow solutions are catching on and are becoming a new class of solutions that are quick to start and have low entry barriers. Newgen, with a world-leading ECM and BPM platform, is uniquely positioned to garner a large market share in coming years. Coming to revenues, our annuity revenues continue to remain strong and comprise 66% of the revenue and witnessed a growth of 11% YOY. Of this, cloud revenue continued to grow rapidly at the rate of 30% YOY. Cloud deployments are expected to accelerate faster in the coming quarter. In terms of verticals, banking and financial services and insurance verticals continue to be growth drivers during the quarter, with growth of 12 and 29% respectively. Employee safety and customer service continues to be the forefront of our post-COVID strategy. We have adopted effective practices and solutions to ensure safe and efficient remote working environment. We are successfully fulfilling our commitment to effective remote enablement measures. These include institutionalizing of new business processes and ways to work, thus leading to better collaboration, efficient delivery, and enhanced productivity despite lack of travel and in-person interaction. We have successfully handled events, demos, architectural design sessions, pilots, supported deployment, and customer operations. The quarter witnessed many projects going live and as well as ongoing rollouts, highlighting the organization's seamless adoption of the new normal. With our agility in operations, we have been able to maintain continuity of business for some of our long-term customers by successfully shifting from on-site to offshore models, leading to better economics for both the customers and us. As an organization, we have always focused on profitable growth as a long-term strategy. Newgen's margin resilience and cash generation powers becomes visible in the current quarter, where profits and margins have expanded even amidst this challenging market. We have made substantial cost rationalization efforts across all spheres, including manpower costs and operational costs. We have optimized our execution capabilities while continuing with long-term investment in R&D and sales and marketing. EBITDA was up by 101% at 16 crores and profit after tax was up by 196% at 9 crores. Further optimization measures would continue in the coming quarters. We continue to extend our reach globally with our direct and indirect sales network. Newgen is focusing on strengthening its SI ecosystem, and we currently have ongoing engagements across geographies with these SIs. We are maintaining our strategy of making continuous investment for future, organic growth, and deploying capital for the right opportunity. We believe this would help us in strengthening the organization and making it more resilient. Our R&D expenditure during the year remained 10% of revenue and sales and marketing efforts at 20% of revenue keeping our long-term plans in mind. Our liquidity position continues to be healthy, with net cash from operating activities at rupees 55 crores during the quarter. Our net trade receivables as on March 31st, 2020 are rupees 221 crores, which resulted in a net DSO of 122 days. While there has been some slowness in collection in the last quarter, we believe that this is not the long-term phenomenon. While in short term, the environmental change challenges are expected to lead to some headwinds in our ability to close new logos, given the disruption in movement, we expect a strong acceleration in demand and adoption of digital solutions across all verticals and regions in medium term. We will continue our focus on growing recurring revenue, profits, and cash flows, and building a resilient business model. We are carefully monitoring the situation and taking all necessary steps, including identifying and leveraging new opportunities for growth, implementing new and efficient ways of working, and expanding margin. We are now open for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1 on your touchtone phone now. Anyone who wishes to ask a question may press star and 1 on your touchtone phone now. We have a first question from the line of Hardik Sangani from ICICI Securities. Please go ahead. Mr. Hardik, sir, your line is unmuted. Please go ahead.
Hi, now am I audible?
You are, sir. Please go ahead.
Yeah. So the kind of work we have done on the PPP program on the US side, so we already have a system and a business case in place. So similar thing has been happening in India. It's the government is giving small SMEs loan to, or kind of a loan forgiveness or moration thing. So do we see an increased traction of offering a similar kind of products in India as well? And if yes, then what would be the typical size like which we can get?
Yeah, Hardik, thanks. This is Jeet. I think for forgiveness or lending programs across globally, we have worked in multiple territories, including India. And India also, we have a lot of existing customers who are looking at some kind of programs which government is running. We are hopeful that in coming months the momentum will pick up. Right now we have worked with one of our existing customers on such cases, and we have 3-4 more cases going on. But you can understand the size of US market is very large in terms of number of institutions. In India, you have roughly around 80 to 100 targets, and so far 40-50 are their existing customers. We do hope that in next 2 quarters there is going to be some momentum in India, but it may not be of the same size. In India, the average deal size for us can be anywhere between around 2 to 3 crores for such a program. But right now, we don't have the same momentum as we had in US to get that.
Okay. So, just second question, even the margins we have performed quite well compared to year on year. So last year, because we planned the headcount and all our planning is done on the year start, so do we think in this year we'll be able to recoup the margins to not around FY19 level, somewhere like closer to that?
Yeah, so I think that this year we are not upfront planning for a lot of manpower addition. So that's one optimization, but there are other optimizations also which are to do with in your operations, in terms of travel optimizations, in terms of the profile of work shifting from close to customers to offshore. So there are multiple optimizations built into the system, and we do expect that the margin position to be better than the last year.
Okay. That's it from my side.
Thanks, sir.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1 on their touchtone phone now. We have next question from the line of Nagaraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi, thank you for taking my question. I hope the entire team is keeping safe and sound. Just wanted some color on the 15 logos we won this quarter, specifically majorly in the US and also the Philippine logo, which you said it says a larger logo. Would the US logos be mostly SaaS-driven business wins? Just some color, I guess, to begin with would be useful.
Yeah, thanks, Nagaraj, and wishing you the same and keep good health. The US is predominantly a SaaS business because when you are saying new logos, these are the contracts where right from the stage of closure to all the way to execution and go live was done in a short period of time. So all these were done remotely using our cloud offering and our low-code development platform, in which the US forgiveness program of what you call paycheck protection program, those were the processes implemented for these 15 banks. And for other markets, we also have the traditional deals which are also non-cloud in terms of our perpetual sales of licenses. In Philippines, we had license sales. In Middle East, we had some customers, and also we had some customers in India. So even in those customers on the traditional model, which are non-cloud, we have really worked out on the processes, and we are able to really deploy on their in-premise installations as well as start the implementation for those. So both from cloud as well as non-cloud, we are able to execute. We are able to acquire customers as well as implement the solutions. But to talk about US more, it's about banks predominantly, which are which onboarded as first process as the forgiveness and the lending process. And in the future, we are looking at a larger tail of revenue coming from as they start doing other solutions on the same platform.
Got it. So these new logo ones wouldn't be the existing pool of bank customers we have in the US. These are customers that came on for this specific product, and we hope to cross-sell going forward. Given that we have a sizable critical mass of US customers now, how is the traction, the pipeline looking like on the the mid-size sub $2 billion asset banks that we're going after? How is the pipeline looking now that we have a good critical mass of cases to show potential customers? Should we target something like 10 to 15 new logo wins every quarter, or what sort of run rate are you sort of internally looking to do this year? I'm assuming there's been no let up in ordering because of COVID by US corporates, by US banks.
Yeah, so I think I'll answer that. I can answer in multiple parts of this question. One is, I think on the pipeline is looking very good. As part of this pursuit of these what you call PPP-based solutions, we have been able to access a very large customer base, a prospect base, where we expect to grow the funnel, grow the opportunity base over next 4 to 5 to 6 months. So overall funnel is very positive, and as Mr. Newgen put is called overall traction for digital solutions, overall traction for solutions which can be done on low code and then fast. There's a momentum in the market. On the closure rate, we do target roughly around 20 to 25 banks in our traditional space every year. That's our target and goal. While as the lending program does accelerate a lot of, such origination cases, but we may not have the same momentum for acquiring 15 to 20 clients every quarter. But our goal is to do at least on the normal non-lending, non-PPP base to get around 25 to 30 logos in a year. That's our target.
Understood. Just how does one question on the India pipeline, given it's a mostly mature revenue pool where we cross-sell new products to most existing customers, how does that pool of revenue now look like on the annuity side? Are banks still adding more products to the platform, or are you seeing a bit assuming this year would be a bit weaker because of how the economy and how banks are likely to do going forward?
See, India is a bit challenging because of various things, because our ability to, get new logos both in our government side as well as because of the merger and consolidation of banks, there is a disruption, and there is an NBFC disruption also. So there is an impact. But on the existing account side, they continue to grow healthy because, as we are expanding our solution funnel from lending to digital onboarding to multiple solutions in trade finance, our existing customers are still finding potential, keep on growing the platform across multiple business lines. So we still expect a very healthy business coming from our existing clients. But we do see some headwinds, at least in the first 2 quarters in India on the new logo acquisition. Because the new logo acquisition, we are having some challenges because we got to build relationships with new customers. For that, travel and other things are also very essential. So there is going to be a element of challenge on the new logo, but on the existing accounts, we have a continuous need to expand those accounts. We have created solutions over last 1 or 2 years. Where multiple banks are now using those products. Trade is one of the areas which is really showing a lot of interest in these customers. Now even the programs like what Hardik was mentioning is the lending and the forgiveness programs which are starting in India. Slowly they're catching up momentum, and I'm sure most of our customers will go with that solution using our systems.
Got it. Yeah. Just one final question. We sort of budget and plan a cost increase at the beginning of every year. So what sort of cost increase are we looking at on our cost base in FY21?
We are not looking at any cost increase on that. We are looking at a bit of optimization on that cost. Because there's a no pre-planning of, increase in your capacity of execution because we are able to get much better scale doing it remotely. The second is, there's an automatic optimization of some operational costs in terms of your travel and other expenses. So we look at, in fact, the reduction in the overall cost.
Understood. Thank you so much.
Thank you very much.
Thank you, sir. A reminder to participants, if you wish to ask a question, please press star and 1 on your touchtone phone now. To ask a question, participants will press star 1. We have next question from the line of Hardik Sangani from ICICI Securities. Please go ahead.
Hey, so couple of questions. So firstly, the question is increasingly we are getting more heavier on the banking and the insurance side. So in other verticals, do we have any specific plans as such to expand our customer base or improving on that part? Second is like on the margin part, did we observe right now? So in the last quarter, so in this quarter, like I said, the recouping of the margin part. So currently, all other companies have started a lateral hiring as well. So on that part, do we see some cost increase on account of increased attrition or the retaining of certain talent? And thirdly, so in this quarter, most of the US banks have done most of their provisioning work, and all that kind of stuff. So do we see any new normal business getting so is any new type is coming back to normal on the US part of the business?
Yeah. So I think there are multiple questions, I think. See, one thing is true that banking and insurance is a substantial part of our business. And so far, even in mature markets, we are finding more and more growth in these two segments, and that's why they are becoming more heavier. We do have internal endeavors to really push the other segments, especially our what you call manufacturing, shared service, and government. And I think there is a common pursuit to do that. But as of now, I think banking in this crisis point also is responding better because their needs of technology are having a much higher priority. So I do think at least for some time, the banking and insurance will continue to be an important part of the revenue for us. And while on the other hand, as we start growing further, we'll start opening other segments as well, and there's a continuous pursuit on that. On the margin side, I think the margin, as I said, the margin positions will keep on expanding for the whole part of the year compared to the last year. But yes, there is an element of seasonality in our cost basis also. I think generally our Q2 costs are slightly heavier on account of a lot of campus guys joining. Maybe this year that cost may shift to Q3. And as the market does open up and the economy opens, we may start, incrementally investing in some part. But I don't think it's going to be a large difference in the cost base around that. So it may vary, and we may have some laterals coming in, we may have some campus guys joining in, but that will not lead to a substantial change. But Q3 costs on manpower will be surely higher than Q1, Q2. That's because of our campus people may be joining at that point in time. On account of, your third question was about US. Could you repeat that, Hardik? Sorry, I missed your third question.
Yeah. So a lot of provisioning and capital raising has been done in the first 3 months of the US as well. The banks have raised capital, provided adequate provisioning. So are business coming back to normal and the projects which were on hold like 3 months ago? Do we see some restart in those kind of logos? Non-COVID part offerings, are they again gaining traction?
Yeah, so what is happening is no business ever stopped. I think it just got slowed down. What's happening, people are trying to live with this new normal, and everybody's believing that this change is slightly more long-term and permanent. So people are moving ahead with their opportunities buckets. So we have a lot of our traditional onboarding and seal of solutions being pursued right now. We do think in next few months, customer will start reaching the decision-making cycles and start looking at closures also. And more and more, it's getting established that the remote working and remote deliveries are quite possible. They don't find any risk with that. But saying that has it returned to normal, or I don't think the answer for that is yes. There is some kind of a new normal, which will drive some demand. But we are still from that the traditional demand that where we have a definitive answer that customers have a very definitive buying cycle. These days, I think the last moment decision making is slow at all places. And US, Europe, we surely see the momentum of customers deciding is much faster than other markets. So there we do expect in next quarter as well as coming quarters after that, the sales momentum continues.
Okay, that's it from my side. Thank you.
Thank you, sir. Anyone who wishes to ask a question at this time, press star and 1 on your touchtone phone now. We have next question from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My question is on slide 16, where you have shown the revenue split by segments. So if you can, and I'm new to the company, so I should preface my question with that. If you can just explain the ATS/AMC and how is it different from support bucket that you've shown here?
Hey Rajesh, thank you and welcome. So this is about Q1, the first pie chart. Is that right?
That's right.
So what is happening, as you understand, the license, SaaS and ATS, AMC, these revenues have no direct costs associated with them. So their margin profiles are very different. They're like typically 90% gross margin because there's no direct costs associated with that.
Right.
While as support, which is an annuity based, because support is an additional support which customers demand beyond our ATS. But this support, the nature of the support is because it is delivered through a service. So there is a direct manpower cost associated with that. So the margin profile, that is like implementation. But the revenue profile is more annuity based and more assured year after year.
Okay. So support is something that you're asking for additional services as beyond your EMC contract, right?
Yeah. So typically very large customers, they may have ATS of 200K or 200K, but they may have to do a global rollout or do a rollout. They would contract 5 more people permanently to take care of their issues, their support. They're making the application live. So
okay.
It's an additional support contracted beyond ATS and AMC.
Understood. So when you talk about your annuity revenue of 56%, are you adding these three together? Is that how one should understand it?
Yeah, it is including SaaS, which is subscription, ATS AMC, and continuous support.
Okay. So in a way, what you're saying is that you do have a visibility on the support being consistent year over year. It may vary from customer to customer, but as an aggregate figure, you expect it to continue to be always there. Is that the way to understand it?
Absolutely. So basically, between these three revenue streams, we don't see any, kind of a significant change. There may be minor changes, and also there is an element between the ATS and SaaS. There is an element of compounding. So as we keep on adding customers, they keep on growing organically.
Sure. But these three buckets, if I add up, it comes to 38 and call it about 66%. So yeah. So this number will continue to increase depending on how many new products you are able to sell. Because I'm assuming sale of products and implementation go hand in hand. And then this is just like any other software company. This will become more recurring in nature as you are able to sell more. Is that the way to understand this?
Exactly. So the sale of products or sale of subscription defines the business, and then these things get compounded like any other software license business.
Okay. So then my one question is on the next slide on debtor side. Almost 2 quarters of your revenues are generally outstanding, right? So what's the thinking and what's the game plan around that?
Generally, if you look at any software license company globally, their debtor days outstanding is between 130 160 days. You can compare it with globally. So what has happened, if you last 2 years back when we started this journey for IPO, our DSO was at the range of 240 days. And it was a bit of also hygiene as well as bit of following up and some of these business areas where in terms of government and other things. So we took up a call that in next 2 years we'll bring it around 120 days, which we have been successfully able to do by doing various internal hygiene things in terms of linking performances, pays to collections rather than sales. So it has come down. And what we think is, beyond this level, this was without pushing customers and modifying contracts and existing contracts. Now what we can do is from here, as the annuity business part of the business and the perpetual license sales start becoming less, and annuity part or the subscription, because we see further this can come back the 80, 90 days in a year and a half time.
Okay. And then in terms of the growth in the US that you talked about, 36%, if you were to pull out the contracts related to PPP, then what would that growth be?
So because PPP billing is not substantial, it may be around 7-8 crores. I think if you can reduce, Dipti, can we calculate that if you reduce 7-8 crores from UP US, then what the growth would be? I think it would be still, maybe 20% or something. But we can check and send you the data.
Okay. So then what is driving this growth? If you can just talk a little bit more about that, because that seems to be something very nice.
So I think US, we have been pursuing subscription-based business for last 2-3 years. So like in other markets, the cost of disruption was very high because we still depend a lot on the new sales. and new logo acquisition is a very important part of our business. So in US, we have a strong base, and the subscription business has been building over last many quarters. So already there is an organically every quarter their base keeps on building. So we had a good run going through in that. And then with this PPP, it did add another 10-15% to that growth. So while other territories, we have this quarter was negative compared to last year's same quarter.
Just to add to that, I think if we exclude those 7 to 8 crores, then we would have roughly 16 to 18% growth still.
Okay, great. Thank you.
Thank you, sir.
That's all right.
Thank you. Anyone who wishes to ask a question may press star followed by 1 on your touchtone phone now. Reminder to participants who wishes to ask a question may press star and 1. We have next question from the line of Praveen Yadav, investor. Please go ahead.
Hello, sir. Thank you. Yeah, I wanted to know, when can we expect these SaaS revenues to, be substantial? Right now, this quarter we have around 10 crores. So, in 2-3 years, how much you see, growth in that?
Yeah, Praveen. You see, SaaS is still growing around much higher than the company's growth rate. So in this time, it's around 30%. So I think we will continue that momentum of a high growth rate in SaaS. And our idea is in next 3 years, we should bring around overall, subscription and annuity revenue almost to 30% of our company's revenue.
Okay. Okay, sir. Thank you.
Thank you.
Thank you. Anyone who wishes to ask a question may press star 1. To ask a question, participants may press star 1. As there are no further questions from the participants, I would now like to hand the conference over to Ms. Deepti Mehra Chugh for closing comments. Over to you, ma'am.
Thank you so much for joining us on the call. For any further questions, you can connect with me or go to the website of Newgen Software. Thank you.
Thank you.
Thank you.